Hello, I'm Anastasia Amoroso, and this is Beyond 60/40. Today, I'm joined by Dennis Schuh, who is the CEO of Starwood Credit Real Estate Income Trust, and he shares where they're finding compelling opportunities in today's market. Then I sit down with iCapital Vice President of Research and Education, Owen Boyle, who helps us answer your question of the month. And as always, I share the one thing that caught my attention this week in private markets. In today's private market poll snapshot, the one thing I'm focused on is commercial real estate, and more specifically, where the best opportunities lie today as the Fed shifts to a more measured easing cycle. Last October, we talked about whether lower interest rates would warrant renewed optimism in the CRE market. At that point, the Fed has just started cutting interest rates, but since then, they've delivered an additional 50 basis points of rate cuts, and now, finally, after 2 years of price declines and weak transaction volumes, we are starting to see a turnaround. Property prices are finding a floor, cap rates and vacancies are, generally speaking, stabilizing across sectors, and transaction volumes, which had been stuck at multi-year lows, they're finally picking up too. So indeed, looking at this chart, you can see that commercial real estate transaction activity has now increased for 4 consecutive quarters, with Q4 of 2024 marking the highest level since late 2022. This pickup in transactions is especially good news because it gives investors more sense of certainty of what the actual real estate prices are. Now, despite these positive developments, there's been one area of concern about the otherwise bullish thesis for commercial real estate, and that is that the Fed may not cut interest rates that much more this year, given the sticky inflation, and now the added concern that this inflation may still go up due to the impact of tariffs. So is that a problem for real estate? Well, here are 3 points that I would make about that. First, even if there aren't many rate cuts that are still ahead, peak rates are now behind us. And that is already supportive for real estate prices. And by the way, many GPs and investors have typically invested throughout multiple cycles, and they've successfully navigated the periods of higher interest rates, certainly higher than what we've seen post-GFC. Second, during the past rate-cutting cycles, private core CRE funds delivered solid returns, averaging 9% in the 2 years following the rate cuts. But more importantly, even in the periods where the Fed held rates steady for a prolonged period of time, returns were still positive. And third, in our view, investors can still see returns in a world of structurally higher interest rates, but selection becomes key. So today, the best opportunities may lie outside of the core real estate. Core real estate typically focuses on stable income-generating properties, and it relies more on broad market appreciation and steady rent growth to drive that net operating income growth and total returns. But the price appreciation potential today may be somewhat capped, given that cap rates may stay elevated given all the policy uncertainty that we have. Now, value-add real estate, on the other hand, is about actively improving properties and making capital improvements to boost NOI growth and, over time, property price. That NOI growth can come from multiple different angles. Renovations and property upgrades, for example, can justify higher rates. Repositioning or repurposing assets can increase occupancy. And operational efficiencies, think better leasing strategies or cost-cutting measures, can improve margins. So the goal is to add value where it didn't exist before, boosting cash flow and long-term property value. And by the way, the opportunity set for this is sizable. Nearly 50% of all the buildings in the U.S. today are over 45 years old, and spending on renovations is expected to double the 10-year average in the coming years. So in a market where appreciation may be harder to come by, value creation through asset enhancements remains one of the most effective ways, in our view, to generate returns. So where does this leave us? Well, from the macro perspective, we've still got solid economic growth, gently declining interest rates, and firming fundamentals. And that is overall a healthy setup for the commercial real estate market. But with political uncertainty rising and a more measured Fed, CRE investors will need to be more selective in where they allocate capital. That means focusing on value-add and opportunistic strategies that can provide return beyond just market appreciation. And that's your one thing in private markets this week. I am pleased to welcome my first guest today, Dennis Schuh, Chief Executive Officer at Starwood Credit Real Estate Income Trust, which is part of Starwood Capital Group. Starwood Capital Group was founded in 1991 and today manages $115 billion in assets. The company has invested $250 billion across real estate, and on top of that, they manage $30 billion in debt. Dennis, thanks so much for joining us today.
Thanks for having me. Great to be here.
It's great to see you, and we are actually going to have conversations about real estate broadly, but specifically about real estate credit and the growing opportunity set that you see there. And to just put some numbers around it, when we look at U.S. commercial real estate, it's about a $20 trillion market. Of that, we have $1.7 trillion that has been raised and accumulated in AUM in equity real estate funds. And then when you look at the real estate debt, AUM today sits at about $256 billion. So it sort of seems like it pales in comparison, relative to what we've seen in equity and the overall asset class. But maybe that's the opportunity that you see.
That is the opportunity. And when you drill even further in terms of private credit and the wealth channel, in terms of the capital flows that have been raised, roughly $100 billion for private credit. Of that $100 billion, only about $5 billion for real estate private credit. So most likely investors are overexposed to private credit in terms of their allocation. We think allocating to real estate private credit is a great diversification tool. Thinking about comparing and contrasting corporate credit and real estate credit, we're making loans on hard assets. We're making first mortgage loans, senior secured, on commercial real estate, high quality institutional assets, on multifamily industrial asset classes. We are generally the only lender, the only creditor on those particular loans, built cash flowing. We're doing that today at today's valuations, not peak valuations in 2021, early 2022. So those valuations are down from that particular level. In corporate land, usually the deals are syndicated, term loans, lots of people, lots of different managers owning a little slug. So you're generally buying the market where pieces of each of those deals are in that. Also, if something was to go wrong, we can simply foreclose. A resolution or a workout in corporate land is much more complicated. So a challenging path to a resolution if something goes bump in the night. And lastly, one differentiator, most of the real estate private credit vehicles are structured as REITs. They have a tax advantage. 20% of their distributions are not taxable pursuant to the 2017 Jobs Act. It's supposed to sunset at the end of 25, but we think we'll get extended. That offers an additional 100 basis points of yield to investors, tax adjusted.
Dennis, you make a very compelling case for the big picture opportunity for real estate debt. But when we kind of zoom in and talk about the here and now, when you think about the rates environment, the default environment, the price resetting environment that we've had, is now a very compelling opportunity for real estate debt.
We think now is a super compelling opportunity. If you think about it, property values peaked in 2021. So they're down anywhere from 10, 20, 30%, depending on asset classes, maybe even higher for certain asset classes like office. So from that perspective, you're getting in at today's valuations for these new private credit vehicles. So you're lending at 65% of today's valuations. Also, we are in an elevated rate environment. So you're all in yields. If you go back to 2021 or early 2022, when private credit lenders lend over SOFR, pretty much always floating rate. SOFR was at 0. So you're lending over a base rate of 0 plus a spread. So back in 2021, base rates were 0, a spread of 300 over, a 3-ish% coupon to the borrower. Fast forward, Fed rate hiking cycle, SOFR follows the Fed funds rate. It went up to north of 5%. It's now right around 430. So lending over a base rate of 430 plus a spread, you're at a 7+% coupon. So your unlevered yields on newly originated private real estate credit have more than doubled. In terms of less competition, that's another important reason. The banks have generally represented about 50% of loans outstanding, and most of the loans that are getting done on an annual basis, the banks have generally pulled back. They're not trying to grow their outstandings. They're trying to actually shrink them. Lots of regulatory scrutiny around their real estate portfolios and legacy assets. So less competition from that perspective. And then there's a wall of maturities that are coming, nearly $3 trillion worth of debt that's maturing over the next 5 years. The banks represent 50% of that. So if private credit lenders can capture 1 or 2% market share, that's tens of billions of dollars from an opportunity perspective.
Yeah, and that has been the story, it seems like, for the last couple of years, that banks are pulling back and private credit funds are stepping in. And, I'm curious, why have we not heard more about commercial real estate defaults? And, is it because the issue is now behind us, or should investors still be worried about it before stepping into commercial real estate?
There's lots of different strategies around real estate resolutions, and there is a lot of proverbial sort of kick the can down the road and working with borrowers on resolutions as various institutions build up reserves and address their legacy problems as a result of a material decline in valuation. Most of those issues are confined into the office sort of sector. So that's a challenge sector. COVID, work from home, technology advances, it's had a dramatic impact on the office sector. So still wood to chop there for sure. Most people think that maybe valuations have sort of bottomed here and you're seeing a bit of a renaissance from back to the office. So we'll see how that plays itself out. Still many innings to play in that regard.
Right, but when I look at today's default rates, they are rising, and presumably they're being driven by a commercial mortgage-backed security defaults. But if I'm a new investor in a CRE debt fund, should I be worried about any of those legacy issues?
You don't have to, because these vehicles, by and large, are all new. So there's no legacy portfolios within this portfolio. So you're getting all new loans at today's valuations with these elevated yields, and you're lending at 65% LTV. So you have lots of cushion. So you have to really look through the negative headlines around real estate. Those have subsided. You can't always wait till the all clear sign. Generally, you sort of miss the opportunity if you wait.
I don't think they ever tell us the all clear sign, but it seems like things have turned around in real estate, certainly in terms of price depreciation. We're seeing stabilization. We're seeing a pickup in transactions. But let's talk a little bit about the yield and the sustainability of that yield. It's about 7 or 8% today. The Fed maybe does another rate cut or 2 or 3, depending on the day, depending on the week. But can investors continue to expect these sort of yields from real estate debt?
Absolutely. So if you look at the forward SOFR curve, it sort of settles in next year around 3.5%. That's still an elevated base rate. So add a spread to that, you're still talking about 6+% unlevered yields or coupons to sort of borrowers. So that's still relative to 2021, early 2022, a material sort of increase, call it 2 times where coupons were. As long as lenders in private credit are able to maintain a net interest margin from where they lend at versus where they borrow at of roughly 100 basis points, plus the base rate and fees on the underlying loans, you can get to levered yields in the double digits and deliver sustainable distribution yields to investor clients around that 7.5%, 8% that most of the private credit lenders are offering.
So can they? Can you sustain the margin? What determines that?
We've been in the real estate private credit business since 2009. We've lent in high interest rate environments, low interest rate environments, high spreads, low spreads, everywhere in between. We have a proven track record for it. The markets are generally pretty efficient in that regard and disciplined in terms of maintaining that net interest margin. And especially with elevated base rates, it's sustainable.
You mentioned some of the best opportunities in deploying the dry powder. Where are you putting that to work now?
So for sure, in multifamily, industrial, student housing, self-storage, these are some asset classes that we think have long-term, really sound fundamentals, generally following demographic trends, population growth in particular markets, some pro-business sort of friendly states where lots of capital is flowing. So a contrarian play would be to do something in office. Most investors don't want to hear about it. If it's that complicated or it's that much of a story, it's supposed to be a much more opportunistic return. The distribution yields in these core plus type of vehicles for real estate private credit are supposed to deliver a distribution yield, not an opportunistic return. It would be a different product then.
Right. So maybe it's not a focus for you, but do you think there are lenders who should be stepping in to the office space?
I think there are lenders that are starting to do that. I think they're targeting much higher returns. I think actually the investors that are coming in to buy that are often just buying it unlevered and not actually borrowing against it because the rates that you'd have to borrow on an office deal are generally pretty expensive. There are still some interesting deals that are getting done on some trophy office buildings in Hudson Yards and some other markets within the country that are pretty dynamic, that have the best buildings, the best tenants. Those are getting done. They're still a challenge.
There's lots of new building, lots of office space in Hudson Yards, but none of that seems to be vacant at this point. Okay, last word, Dennis. What do you say to a private wealth client who maybe has invested in corporate credit, as you talked about in the beginning, but is thinking about shifting some of that allocation to real estate debt?
I think it's a great entree point. I think it's a great diversification tool, and it's a really scarce product that you have a hard time finding. So I think it would be a great value add to your portfolio.
Right. And obviously floating rate exposure with rates presumably high for longer, 7 or 8% yields that are most likely sustainable. That does make it a compelling proposition for sure, Dennis. Thanks so much for joining us today.
Thank you for having me.
Thank you. Today, in our Spotlight segment, we're answering your question of the month. And I've asked my colleague, Owen Boyle, Vice President of Research and Education at iCapital, to help us out. So, the question we received this month is this: allocating to alternative investments can be complicated and time consuming, especially when targeting specific investor goals. How can it be simplified? So, Owen, thanks so much for joining me today.
Thank you, Anastasia. Thanks for having me.
All right, let's tackle this question. How can allocating to alternatives be simplified? Can it be?
It most definitely can, right? It's a major pain point for advisors and investors figuring out how to allocate, where they should be allocating, who they should be allocating to. And so the way at iCapital that we've determined to tackle this problem is through model portfolios. As you know, model portfolios have been around for a long time, but they've only been focused on traditional investments, so equities and bonds. We really view this as a way to give investors more streamlined access to private market alternatives and help them solve for goals such as, a balanced approach, focusing on growth, focusing on income, and really just sort of an interesting, I'd say, cross-section of both the financial side of what we're doing and tech.
And the simplicity part of model portfolios, I guess, comes from a couple of places. First of all, there's this large universe of managers. If you're new to alternative investments specifically, you probably don't know who all the managers are and what the track records are and what the products are. And then the other part of that is also the actual transacting part of that and, dealing with the sub-docs. So how do you simplify each one of those?
I think that our model portfolios are sort of a great crossover between the fin and the tech that iCapital does, right? So on the financial side, really leveraging iCapital's research and education team, who's out there every day meeting with various managers, underwriting strategies, helping to pick some of the best funds that are out there, utilizing various technology to come up with the ideal composition of a particular model portfolio. And then finally, also leveraging all the great tech that iCapital has in terms of making that subscription process a lot more streamlined, right? So you're maybe allocating to 4 or 5 funds, doing that sort of through a single access point, as opposed to filling out, 5 different instances of that subscription. So I think what we're trying to do is really take that burden off of advisors' plates. In the construction of these models, I like to say it's a little bit art and science. The art kind of coming in at the first step, which is determining the applicable universe, right? So you mentioned there are hundreds of different managers out there, thousands of different funds. It can be very complex and complicated. So really what we're looking for are open-ended funds that give investors quarterly liquidity, funds that are available on all major custodial platforms.
Yeah.
And then finally, funds that have 2 years of a track record so that we can sort of analyze how they've performed. And then from there, we're sort of doing more of the science, which is de-smoothing the volatility, understanding how these assets actually trade and are priced. We're also then kind of coming up with our own forward-looking capital markets assumptions. The fourth step is really around putting constraints on the portfolio, right? We want to make sure that they're adequately diversified. We want to make sure that we're not too concentrated in any one fund, in any one manager. And then finally, doing a mean variance optimization, overlaying that with a Monte Carlo simulation, making sure we're sort of removing any outliers to come up with the actual model in terms of what we see as the best combination of funds to achieve that particular objective. Generally looking for, if one fund is zigging, the other fund's zagging. And then that's really how we come up with sort of the goal model portfolio, for investors. And, you touched on the technology a little bit as well, right? Sort of utilizing iCapital's tech, particularly our multi-investor workflow tool, to sort of streamline that subscription process into a single access point.
Right, which is a big deal as well. But you mentioned the goals-based approach, and there's actually 3 different types of model portfolios today. We've launched the first one about a year ago, but there are 2 more that have either launched or about to launch. So talk to us about what are the goals-based portfolios that we offer today.
Last April, we launched our balanced model portfolio designed to maximize Sharpe ratio. So you're getting exposure to all the major private markets asset classes. So we've got 50% to private credit, 30% to private equity, 20% to real estate, giving you both capital appreciation and income. Last November, we launched our growth portfolio, which is all private equity designed to maximize capital appreciation. And then, as you alluded to, hopefully over the next few weeks, we're going to be launching our income model, which is optimized to provide the greatest yield, greatest distribution, and that's going to be all private credit exposure.
Right, that's great. Private credit exposure, but I'm sure there's a lot of different flavors within private credit as the asset class has grown.
Exactly. So I think it's going to be a nice kind of spanning the gamut of upper mid-market, core middle market, and lower middle market to really give you sort of all the flavors within the corporate private credit landscape.
Well, this is great, Owen, and we know that a lot of thought and a lot of quantitative and qualitative work goes into building some of these portfolios with those client goals in mind of growth and income and also just a balanced outcome. So thank you so much for walking us through that, and it certainly seems like this could go a long way in simplifying an allocation to alternatives. Thanks so much.
Thank you.
And we'd like to hear from you. Send us an email at yourquestion@icapitalnetwork.com and let us know what questions are the top of mind for you and your clients. I'm Anastasia Amoroso, and thank you for joining us today on Beyond 6040. We'll see you next time.